Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenborg.
Because it's not how much you make in the markets, it's how much of that you can keep.
To infinity and beyond. SpaceX and Elon Buzz Lightyear Musk. The IPO that everybody's talking about, and I've gotten calls from 8 or 10 clients. Can you get me in? Can we get that? Can we get that IPO? Now, will it go up to infinity and beyond? Methinks not, or maybe not. Price is truth, no exceptions, period. Always remember that. Now, we did the historical data of IPOs last week, but we're going to review that again because it's worth a revisit. And you should also watch last week's show too, because many clients call with FOMO, fear of missing out. Folks, most hot issues, hot money, oversubscribed IPOs actually don't do well. They do what's called gap and crap. They go up and then they dive. So normally you want to wait for a while and wait for a big bowl to develop and then look at it on the right side of the base. Then we're going to go to the markets in our portfolios and talk about this kind of pullback, this hard pullback in growth stocks and our approach, right? So the growth names broke the 21 exponential moving average and then came down to the 50-day simple and held, while the indices almost came down to the 50-day simple moving average. So I will want to explain our portfolio construction and our approach. And then Connor's going to go over Don's on vacay this week. Connor's going to go over the indices, short-term, mid-term, long-term, all that stuff like we always do. Okay? So our portfolios have one half in S&P exposure. One's based on the 21 exponential moving average. That's a short term. And we can dial up and down risk very quickly, beta up and down by selling that. That's more actively traded. And we can use a leveraged or double or triple, right? The second layer is based on the 50-day simple. And the last layer, the last thing to let go to where we move to total cash or even maybe slightly net short is the 200-day simple moving average. No bear markets occur above the 200-day simple moving average. That's just the way the math works. Okay? So again, half of our portfolios are based on IBD CanSlim rules with some of our own proprietary rules. Like Don's got specific position sizes for each individual stock based on their own average true range and beta. Okay? Now, if the markets hold here and continue to go up, then we're going to add exposure and actually are right now as we speak. So we will always do well during trends, but when you're range bound or high single digit pullbacks, we may or may not. But we will always protect your money against big drawdowns, big corrections. Well, corrections is classical definition is 10% or more, and especially bear markets, 20% or more. Okay? And that's what we're doing. We're following our plan, and price is truth, no exceptions. So I'm just going to do this conceptually, kind of an overview. I'm not going to get too detailed, but the first 4 or 5%, we're not really getting too defensive. That's just kind of the market breathing, just moving. Because you want to separate the signal, the trend, from the noise. Okay? Now, each individual stock on that half side, half the growth stocks, will actually have they'll get stopped out based on their own rules. But if we start getting a pullback 5-6%, normally the growth stocks start going first and they get hit quick. And a lot of times there's a rotation to value. That's why we have half the portfolio in S&P stuff, so we catch that rotation. Because if you're doing pure CanSlim or pure IBD and you have large position sizes, that can get awfully volatile at times. Okay? So the market actually pulled back mid to high single digits, and our growth stocks got stopped, and quite frankly, they were extended. They were we weren't buying them for new clients, but for older clients, they were extended, had big profits. They pulled back. So we did get back some of our profits, but they got hit pretty hard. The S&P part was okay, except for the 21 simple. We still held the longer term. And that's how we manage the portfolios, because it's all about risk-adjusted returns, not total returns, not yield, not anything else. Okay? So TurboTection that Ted and Connor run, that was actually doing very well, up over 400 basis points ahead of the S&P. With that pullback, now they're behind the S&P by about 1%, 1.5%. But if this trend continues to go upward, they're gonna do the same thing again, right? Don is now 200 to 300 basis points behind the S&P when he was roughly about even, maybe slightly ahead before this pullback. So in a strong uptrend, we will do well because we have the best of the best, and we don't buy rotten fruit. We don't try to own all the market. We try to own the strongest sectors and leave out the bottom 30, 40% for tail risk. Okay. TurboTection can be a little more aggressive with larger position sizes. Now, if the market starts going down and breaks that 9, 10, 11%, then it really accelerates a lot of times. Volume picks up, and that's when you get a deep correction or even a bear market. We always protect against that. So in trends, we do extremely well. When the market goes sideways or in a channel, right, then it depends on the range. But when the market pulls back, we got to get defensive because we promised our clients we're going to protect them. So on a snapback, we will now be under invested and we will lag the market. That's just the way the math works. And if you're doing the CanSlim method, you need that 3-4 day follow through and all the charts are broken. So it takes a while. So it takes 6, 7, 8 days before you start getting fully engaged again. That's why the other half of the portfolio does very well, because if it doesn't go into correction mode, you still have that S&P exposure. All right. Now, if you got any questions, you can reach out. Just go to revereasset.com. There's a contact us button, and you can it'll come directly to all of us. All right. Now, with that, let's go to Connor and find out what the market is telling us after the markets pull back to the 50-day simple moving average, or almost, and look like it might be breaking big and it might get really ugly. But now it looks like it's holding. So let's see what Connor has to say. Connor?
Yep. Thank you, Dan. I am stepping up for Don today. So we got to chart the S&P 500. And one common thing that we've seen a lot this year is just volatility and the pullbacks being very quick and sharp. And you can see we're just coming off a recent pullback. The S&P 500 from high to low pulled back about 5%. But, what Dan was highlighting, when the S&P 500 pulls back 5%, the leading growth stocks can pull back 30, 40% because some of these stocks have, over 10% ATR, which means that their average true range for the day is 10%. And so this pullback was, for a combination of different things. Number one was we were pretty extended. It was a V shape off the lows, and there was no real pullback, so we were extended in the market. And then one of the initial catalysts was the strong jobs report, and that skyrocketed the odds for a hike to 70%, and that the market was fearful of that. And then also you had the Korean markets, which are very big for the AI trade. They were pulling back, and that kind of some of that fear transitioned over into the U.S. markets, and then just tick ups in rates and the dollar also. And then recently, as the war headlines have been coming back up, and we're seeing more volatility. So again, all the reasons don't really matter. And at the end of the day, when we look at the S&P 500, we held the 50-day moving average and the 10-week moving average. And William O'Neill always says the first pullback to the 10-week moving average after a strong move up is typically a buy. And really, the market's doing nothing wrong. People always get fearful for many different things when price declines, but when you zoom out, it was needed and it's actually healthy. And if we'll look at the Qs as well, you can see similar thing. Qs actually are showing a little bit of relative strength as they never even touched the 50-day moving average. And now you can see today, decent day in the markets today, looking to reclaim the 8 and 21. But the star of the show today is IWM. And this one's making new highs today, which is very bullish. And I'll draw it. You can see this trend line. This RS line is finally breaking out as well, which is a really good sign, meaning that potentially small caps might have some sustained outperformance versus the market, and this looks very promising. And again, typically a good sign when small caps are moving higher for the market. If we take a look at some of the other dominant themes right now as well, you can see the semiconductors, right? They never even touched the 50-day moving average on the pullback either. But pullbacks are quite quick, from over 600 to all the way down to lows of this was to under 600. So, or yeah, sorry, I'm reading that wrong. And this one never broke the 50-day moving average either. And this looks like it's potentially trying to break out from this flag as well. And like I mentioned, the Korean markets also, EWY's South Korea. And why this is important is because, big stocks like SK Hynix and Samsung Electronics, they're very big in the memory space. And so typically this is a good kind of forward indicator. And this pulled back as well, never broke the 50-day moving average, and now reclaiming the 8 and 21 ETF. And so that's a really good sign as well. And then if we take a look at the VIX, we did get a volatility spike also. We in the videos every night, we talk about the ATR, the S&P 500, and it was about 0.9 for a while. And when the VIX ticked back up to over 20, that popped all the way back up to 1.10, which always is a little bit of a red flag. It's harder for our strategy when the market's very volatile and very news-driven headlines. But now we're seeing some of that fear come off. VIX is back below 20, which is a good sign. And then also during this, we got a pretty big spike in some of the sentiment readings, like the put to call ratio spiked up, which typically can be a good sign for perhaps short-term bottom. And then every Thursday, we get the new AAII and the NAM exposure index readings. And the AAII bulls went down substantially, and the bears ticked up to almost 40%. And so that's, if you're bullish, that's a good thing. And the NAM ticked down as well, essentially meaning that, some people got stopped out of longs, and it's just a good contrarian indicator. One area of the market that's been really lagging is the Mag 7. And you can see this is sitting right at the 200-day moving average. You can see this had a failed breakout through 70. And, some people are speculating, maybe big funds are selling Mag 7 stocks to buy the SpaceX IPO. It doesn't really matter. The only thing that matters is price. And you can see this has been lagging quite a bit. If you look at some specific Mag 7 names, I mean, this Microsoft chart is awful. You got that pop up above the 200-day moving average. Looked like, maybe this was starting to bottom out. And you can just see relentless selling over the past, 2 weeks, down every day. Amazon's been another one that continues to struggle. This one's back into the 200-day moving average. Let's take a look at Meta. Same thing here. This has just been dead money. You can see the RS line is sideways to flat, and these have just been lagging quite a bit. Definitely not where you want your capital to be right now. And then, we'll take a look at some of the leaders as well. I know Ted and Todd are going to cover, but just some of the dominant names in the market right now. Sandus is making new highs today, and just a routine pullback to the 21 EMA and having a heck of a day today again. Micron, same thing here. This one held the 21 EMA and, briefly popped up above 1,000 today, now coming back in. And then Intel, another big semiconductor name. This one's got a pretty nice flag. This is a setup that we're seeing in a lot of stocks right now. Is you had that initial big move up, pulled back, basing, undercut this 102. But these can be choppy periods as well. But this one's doing, nothing wrong. And this is what you want to see for a leading stock after making a big move, and, starting to flag out quite nicely. Some other dominant names, Marvell, this one, similar as to Intel, had the big move up, and now it's just starting to kind of high tight flag. And then ARM's another one that looks great. So, leaders pulled back quite hard, but overall the structure wasn't really broken on too many of them. And, both portfolios got stopped out on quite a bit of names. And that was just a combination of, raising the stops to guarantee the gains. And there's just been a lot of, 2x4 and 4x6 days in the market. And when you look at the indexes, you wouldn't really know, but it's, looking at some of these high beta leaders, you can see that how harsh the pullbacks are. And that's why it's so important that you need to trim into strength in this type of market, because, the pullbacks are vicious and they're very violent, and kind of the nature of this. And I know Todd's talked about it before, but reminiscent of, 1999 and those super strong markets and a, technological boom, the pullbacks are always just as hard as the way up. So that's just why, having a little bit of diversification in different sectors is key as well. And that's, and I'll bring up Lilly for that exact reason. And you can see this has got a really textbook base here at the highs, flagging quite nicely. And so this one, Don owns it in Grotection. We don't have a position in Turbotection, but this is a perfect example of owning a leading stock that is more so uncorrelated to the AI trade, because essentially nearly everything is correlated to AI. You could argue biotech as well. You can see this is quite a nice base that it's forming here. And that RS line is finally getting back above the 21 EMA as well, which is a good sign. So really, bottom line to summarize is the indexes are reclaiming the 21 EMA as of now. We'll take a look. Well, right there, pulled back a little bit off the highs, but bottom line, the 50-day needs to hold, and then it's just monitoring the action in the leaders, which so far the stress test has held. Sentiment readings have came down, and maybe the wall of worry continues. So that's really the bottom line. Dan, you got any questions?
Explain what a high tight flag is for the retail investors. I know, and we've got a bunch of stock nerds that know exactly what you're talking about, but
yep, absolutely. So high tight flag essentially is it varies, but basically you want to see a stock make 100% move in a rather short period of time, and then the pullback no more than 15%, in the flag for, I want to say it's no more than like 3 weeks. I don't know the exact numbers.
Can you draw the triangle to show them that Don does that so they can see that?
Yeah, so I'll show Sandus is probably a good example. Yeah, you can just, or I'll go back to ARM. Or Marvell's.
There you go. Now, draw the triangle from the top and the bottom going.
So you got the big move up, and then you can see this declining tops trend line, and then building higher lows here, and basically you want to see this break through that down trend line, and that would be the trigger. These typically, if they're going to work, they work right from the start, because it's a very powerful pattern. Inherently, the stock is already extended, but as we know, best stocks typically get more extended, and we like to buy high and sell higher. And so this is a really good example of a high tight flag, multi-100% move, pulling back very orderly, no more than 15-25%, and watch and see if this one can break out of this flag
and go for another big move, right? Okay.
Yep.
All right, that was good, Connor. First time around, man. Did a good job.
Thank you. Thank you.
All right, who's up first?
Ted, want to?
So, like Dan opened with the podcast, SpaceX just started trading. The indication, well, the price that was supposed to open at was $135 a share, with them selling about 550 1.5 million shares at a valuation of 1.75 trillion. It ended up opening up at $150 a share, which is approximately, one second, at 1.94 trillion valuation. And currently, SpaceX is trading at $163 a share, putting it around $2.1 trillion in market value. So definitely the hottest IPO, the biggest IPO ever in history of the stock market. So what are our expectations? What are our thoughts right now? For us, we do not buy IPOs on day one, and the statistics just show it's not a profitable strategy, or at least in a longer term time frame, it's not a profitable strategy unless if you're a scalper, day trader, or even a very, very short term swing trader. And so if you look at some IPOs of the past, and we talked about this last week, I showed some data and graphs. So if you want to refer to that one, you can see some of that as well. But we'll just talk about a few names and some potential scenarios. One is Hood, if you can pull that one up and go all the way back to its 2021 IPO. And so this is one scenario where it IPOs, maybe it forms some days tight, and then it blasts off in a momentum push. But you can see that lasted 4 days, and instantly after 4 days, I think that hit $80-something a share, and within the next few weeks, it's all the way back sub 40. So 50% drawdown in a few weeks after it hit its highs. And that could potentially be that one scenario because SpaceX is so hot, there's only about 5% of its float trading right now. Another one is Palantir, also came out during the hot IPO and SPACs market of 2021, that COVID bull market. And this one is another scenario where it IPOs, forms a base, and this potential, if this happens for SpaceX, we would be willing to potentially trade it. You can see Palantir formed a 1, 2, 3, 5, 6 week base, really nice IPO base, clearly defined line by Connor, and this went on to make a 200% plus move before it topped out and also dropped 90% plus from the highs. One important point to note is Hood and Palantir IPO'd significantly lower in market value, far lower than 100 billion even. I forget exactly the market cap both these companies came out, but again, SpaceX is already 2.7 trillion, putting it at the 7th most valuable company in the world, potentially 6th if it continues to push here, and it would overtake TSM at 2.12 trillion. So you have to put all of these into context. Most people just look at the share price and they just think it's heading to 1,000. But you have to put it in terms of share price times shares outstanding, which gives you the market cap. And at some point, it's just the law of large numbers. For this to 10x, it would be over 20 trillion market cap at this point. That's not too realistic if you were to ask me, especially regarding its current revenues and just how everything works. Because Nvidia making, I think, 300, 400, 500 billion in revenue a year now is at about 5 trillion market cap. So you can just really do the math there, and you're having your expectations overblown if you think this is heading to 20 trillion within the next year. So
and if one rocket blows up like Challenger, then you get negative news and it can crash. So there's a lot of risk in that stock, I think.
And then another important point is that SpaceX, well, we all know with IPOs, usually there's a 180-day lockup period. With SpaceX, they're having a special situation where they're having a laddered lockup expiration. And I don't have the exact specifics, but it revolves around performance of the shares as well as the next upcoming earnings releases as well. So right now, SpaceX is trading about 5% of its float. There's about 95% of the company still locked up right now.
By insiders private, and so they can sell after the lockup period. And if they sell a big chunk at the lockup period, that stock can drop pretty good.
Right. And then another important point here with SpaceX is there's some special forces acting on this right now. Previously, no IPOs would really be added into a major index, but the NASDAQ 100 and the FTSE Russell are making an exception here. So the NASDAQ completely scraped its traditional 10% minimum public float requirement ahead of SpaceX's debut. And they're just implementing a 3x multiplier to it to allow a low float mega cap or fast track inclusion in just 15 days. So you'll have naturally passive flows from pension funds, from passive mutual funds flowing into SpaceX. But at the same time, you'll have the forces of insiders eventually selling as well, or hedge funds shorting it or trading it quickly and then turning it over for a quick profit. And then the FTSE also waived its standard 5% minimum free float, and SpaceX will have a fast track into the Russell 1000 within 5 days as well. But the S&P 500, they decided to not alter its rules, and it'll take at least a year for SpaceX to be included into the S&P 500. So another couple recent IPOs I want to show is Circle. Again, this is another hood-like IPO price action where it really just takes off, makes a 150, 200% plus move before topping out, and then the same fate as hood dropped 50% plus after a few months. And right now, is that 73% off highs, Connor? I can't read the words up there. I believe
Yes.
that is
73.68.
Yep. And then another one that's similar to Palantir is CoreWeave recently. It made a small push after IPO, but then it pulled back and built an IPO base, and that was definitely a tradable move for a couple 100% move.
Yeah, the right side of that line is where you would get in.
Yep.
Exactly. But if you extend the time frames just a little more, the insiders start selling, and this one is now down 45% off the all-time highs. And at one point is down 50% plus.
And that's why you need
highs.
buy and sell rules, both buy and sell rules.
Right. And so when you look at these previous IPOs, whether it's Hood, Palantir, CoreWeave, or Circle, really for us, if you truly want to catch that true long-term uptrend, you really just have to wait at least 180 days post the IPO, and oftentimes even 1 year after the IPO before you can really expect the true institutionals to start buying. And for example, let's go to Palantir and Hood, Connor, just quickly.
Yep.
You can see after they topped out in 2022, they went sideways for many, many years. And then eventually we went to a new bull market. Catalysts came in, they started growing their earnings, and then they made a huge move in this recent bull market. That's Palantir right there. And if you can quickly show Hood. And there it is. Multi-years of basing after the IPO, and now it finally made a big move. And you can remember these were just like SpaceX in a way. They're both two cult stocks, two big figureheads that lead the company, founder-led CEOs that have big personalities, just like an Elon Musk. So it was similar back then. It was a hot IPO market. They came public, made some big moves, and then eventually trapped a lot of people for many, many years, being down 80, 90% plus. So our expectations for SpaceX, we're willing to trade, swing trade, or even position trade, maybe a few weeks, few months of a move if it does give us some more constructive price action. In terms of buying today, it's just not part of our strategy.
Gambling, speculating, yep.
Yeah. It's much harder to manage risk because you don't have true levels to work against. And even on a longer term perspective, it is probably better for anyone really to wait 180 days, 360 days before really thinking about accumulating some shares for long term.
So remember, folks, thanks, Ted. That was great. So remember, folks, these private equity guys, Elon Musk and all these private investors, they have asymmetrical information. They know more than you do, and they're trying to sell it to you. Okay. Now, there's an argument that, yeah, they need some money for operating capital or whatever, right? But if it was that good, would they sell it to you? They normally try to get the junk off. They offload a lot of IPOs. Only a few are hot issues. This is one of them. But they're only doing 5%. That's a very small float. The smaller the float, the easier to manipulate the stock. Or the more the stock, when they start selling in that unlock period Ted's talking about comes, the more that stock will go down. The bigger the float, the more liquid it is, and the more that it's actually traded on the exchange by mutual funds, ETFs, everybody. Okay? So it's not that this stock won't go up. And hell, it may go up 100, 200%. But until it gets some stability and you see, it's gambling. That's the way we feel. I mean, go back and look at Facebook in 2013. That formed a huge deep bowl. Popped for a couple days, and then they call it gapping and crapping. It gapped and crapped. Okay? That's why it's risky. So of 10 of the hottest issues, only 1 or 2 is going to work out. Just keep going up, straight up. Here's the other thing. If you do get, so it's a lottery. If you do get on the IPO list where you get shares, because the custodians that are the underwriters, the bank underwriters that are issuing them, if it's oversubscribed, they're supposed to do it on a lottery. So if you say, I want 1,000 shares for my account, you may only get 200 or none. You don't know. You may get the whole thing. You may, they got to show that it's fair to the regulators, right? But then they expect you to hold that for at least a certain 2 weeks, 3 weeks, or a month or 2. That's because if you don't, they'll blackball you on the next IPO because they're trying to support the stock. The client is the stock, the underwriting and taking the IPO. You're the cattle. He's the roper delivering you from market. Okay? Remember that. The other thing they do is they prime the pump, meaning the underwriters will buy a little bit the first day or 2. They'll buy it and try to get people to go, oh, look, it's going up, to get them in. And then they withdraw. It's called priming the pump. That's why IPOs are very, risky and dangerous if you don't know what you're doing, and they're very hard to manage. And again, it's asymmetrical information. All right, that's what I got. Ted, that was great. Who we going to now? Connor, Todd?
Todd.
Okay. All right, Todd.
Well, thank you. My piece is going to be calming today. Low volatility. I'm going to talk about some stocks benefiting from the AI revolution in the software area. And all these are really pretty quiet relative to what's happening really recently over the last week with the volatility as well as today. So first name is going to be DigitalOcean. And, this has just been a great post-earnings gap play. It's done a marvelous job of just holding the 8-day moving average. And notably, this week, had a little bit of a test of the 21-day moving average on Tuesday. Wednesday, being a down day in the market, this one was green and really has just been trading super tight along the 8-day moving average. So wanted to talk about 4 of these names, and this is the first one, which is just showing very nice relative strength here. And to make it quick and get through this, Snowflake will be the second one. Snowflake is, another beneficiary of the AI. They're into data warehousing and analytics. And you can see this had a massive earnings gap. We've got positions in this. And what's really notable about this too is it's been really tight. Tuesday, Wednesday, Thursday, all relatively tight closes right along the 8-day moving average. Down a little bit today, but just quiet, really straightforward. If it drops a couple percent below the high volume close day, just an easy stop loss here. But with that type of momentum, nice digestion post earnings gap, quiet action, definitely a good setup here right now. TWLO is the next name. TWLO's customer engagement software. Think of Uber when you get your texts that, your ride's almost there. This company really controls the market for transmitting that voice, text messaging, everything, video. And again, another name that just showed very nice earnings growth in the AI area. And what was really nice about this chart it had this huge spike on June 1st, which was quite notable. And it's come down on Tuesday when the market really sold off hard, held the 20-day moving average, and is also trading really tight along that 21-day moving average. So these are all actionable plays potentially right in this area. And Datadog, finally, the last name, I personally bought that earnings gap. It did some offensive selling into that spike and sold the rest out on the break of the 8-day moving average. This is pretty normal. These things get really extended. It's digesting nicely, but also really showed nice support on the 21-day moving average here. So again, a lot of things are flying around right now. Big ranges on a lot of the optical stocks, the semiconductor stocks, which makes it really hard to get into the positions right now as well as stay in the positions. But all these are very tight along key moving averages as well as easy stop losses. So just wanted to bring this area to your attention.
All right, Todd, thanks a lot. That was very good. Listen, folks, so Todd's right. These growth stocks are not meant to buy and hold. They're just not. Okay? So, Bill O'Neill, IBD, even did a lot of research and studies on that. And the leading stocks, the best of the best, when they hit their own bear market or they fall because of the market itself or just because they now came out of favor, they drop on average 72% from the top. That's why buying and holding these is not a good idea. That's why half our portfolio is active, very active. The other half's active, is management, active management too, but is very, very active, and we pay a lot of attention and have very strict buy and sell rules. The other half is, the 21-day moving average based on the S&P is still active. So roughly 60% of the portfolio is very active and a little bit shorter term because we don't want to give up profits. The other 40% is longer term, mid-term and longer term based on the 50-day simple and the 200-day simple moving average. And that's based on the S&P. And it's all about risk-adjusted returns. How much return did you get for the risk you took? And the simplest measure of that is, what is your drawdown? How much during a correction or bear market, how much did you go down relative to the market? Total return doesn't mean anything. I could buy 2 stocks, be up 80%, and got lucky. Of course, I could be down 80%. That's why you want to know how much risk are you taking to get that return. Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just go to revereasset.com, go up in the right-hand corner, there's a subscribe button, and you'll get this newsletter. We put out a newsletter every night the market's open. And then we do this podcast on Friday morning. They even do stuff on the weekend. But that's on YouTube. YouTube you'll get all the same stuff, but you don't get the Saturday stuff. So if you go, there's 2 ways to sign up. So just go to YouTube and look for Revere Asset. Just type in Revere Asset and hit subscribe. Zach will have this podcast we're recording now. What time is it? It's 11:19 Central. He'll have this out probably by 12 noon, 12:30, something like that. That's what our stock nerds do. And if you want to contact us on our website, next to the subscribe, there's a contact button. You can ask for a portfolio review, how to become a client. You can ask questions about a stock you want us to talk about. Okay? And you can always call us old school at 855-REAL-WEALTH. Don't forget, it's your money, not Wall Street's money. It's your money.
Because it's not how much you make in the markets, it's about how much you can keep.